Welcome to this explainer. Today, we're undertaking a massive deep dive into a financial event that sits right at the white-hot intersection of global capital and the artificial intelligence boom. We are looking at a deal so large, it literally has the potential to reshape how the entire global tech supply chain operates. Okay, let's dive into this. $28 billion. That is the staggering size of the capital raise South Korean chipmaker SK Hynix brought to the US Nasdaq exchange. When a number with this many zeros hits the market, well, it's not just your standard stock offering. It is an absolute mega deal. It represents a massive influx of foreign stock listings, essentially bridging international capital markets with specialized high-tech manufacturing. But you might be wondering why now, and why this specific company? The essential context here is all about capitalizing on the absolutely insatiable global demand for artificial intelligence hardware. We're in the middle of a total AI frenzy right now. To put that into perspective, just a single next-generation AI data center can require tens of thousands of these specialized chips just to function. SK Hynix engineered this multi-billion-dollar listing specifically to seize this exact moment of peak industry growth. They recognize that right now, the appetite for the physical components that actually power AI is at an all-time high, and they're going to need immense amounts of capital to feed that demand. And that brings us to a really fascinating perspective from the American Bazaar. They called this offering, quote, a financial barometer to measure whether global investors still have strong confidence and capital to support the artificial intelligence hardware boom. This is absolutely crucial to understand. This deal isn't just about SK Hynix getting cash, it's a major test. You see, after periods of heavy stock market volatility, the entire financial world is watching closely to see if public market enthusiasm can actually still absorb a multi-billion-dollar technology offering like this. So, to make sense of all this, we're going to follow 5 clear steps today. 1. The $28 billion AI bet. 2. Bridging markets with ADRs. 3. The deal makers and markets. 4. Following the impact chain. And finally, 5. Risks in the AI frenzy. All right, let's kick things off with Section 1, the $28 billion AI bet. You don't just ask the market for $28 billion without a rock-solid blueprint, right? The primary objectives here are highly focused. They want to fund advanced manufacturing capacity and significantly expand their production lines for those specialized AI memory chips. But there is a very deliberate financial strategy at play here too. By tapping into U.S. capital markets, management provides global and U.S.-based investors with a direct, dollar-denominated way to buy shares in a leading AI hardware supplier. They're timing this perfectly to maximize funding during peak industry growth, basically making sure they have the war chest they need to maintain their market dominance. Moving right along to Section 2, bridging markets with ADRs. Now, what's really interesting about this is a very practical, vital, mechanical question. How exactly does a South Korean stock trade in US dollars on the Nasdaq? Usually, there are strict international trading restrictions in place that totally prevent you from just logging into a US brokerage account and buying shares directly off the South Korean exchange. Enter the ADR, or American Depository Receipt. This is the brilliant financial bridge used here. By definition, ADRs are certificates traded on U.S. exchanges that represent ownership of foreign shares. So SK Hynix issues these ADRs so that global and institutional investors can purchase these U.S.-listed shares using U.S. dollars. It completely bypasses the restrictions and the headaches of trading directly on the South Korean stock exchange, opening the floodgates for Western capital. Of course, it isn't quite as simple as just printing up some certificates. After submitting detailed regulatory filings to the SEC that outline the financial health of the business, the company actually has to price this mega deal. Share volumes and pricing are meticulously set by evaluating institutional demand, current market valuations on the Nasdaq, and, of course, the primary stock price back in Seoul. Management has to constantly adjust these fundraising targets in response to any short-term pullbacks or volatility in global semiconductor stocks before the shares officially even begin trading. That brings us to Section 3, the deal makers and markets. Let's map out the players. This whole deal rests on 4 main pillars. First, you have SK Hynix themselves, bringing their vital role as a market leader in high-bandwidth memory, or HBM chips, which are absolutely required for AI systems. Second, the institutional investors. These are the large entities purchasing huge blocks of these newly available shares. Third is the Nasdaq exchange, which acts as the U.S. stock market hosting the trading platform. And finally, macroeconomic sentiment. You really can't ignore the massive influence of interest rates and tech sector valuations on whether a deal of this magnitude flies or fails. Now, let's zoom out a bit for Section 4, following the impact chain. And this brilliantly illustrates how a $28 billion deal absolutely does not happen in a vacuum. It triggers a massive global domino effect. Step 1, strong investor participation supplies the massive capital injection. Step 2, that capital goes straight into building brand new fab plants for advanced AI memory components. Step 3, this increased hardware output physically helps ease global supply shortages, which leads directly to Step 4, tech companies can finally scale up their AI data centers and cloud services. We literally go from abstract billions on Wall Street directly to the physical AI cloud services that you and I use every single day. Finally, we need a reality check in Section 5, risks in the AI frenzy. So the crucial point is that we impartially weigh the practical implications against the very real vulnerabilities baked into this. On the pro side, investors get direct AI memory exposure without dealing with foreign exchange complexities, and SK Hynix gains an enhanced global profile aligned with Western tech peers. But look at the cons. Regulatory conversion limits can create real trading friction and artificial price premiums. Plus, there is a remarkably high sensitivity to any potential slowdowns in AI spending. To elaborate on those limitations, this deal is heavily dependent on continuous, massive spending by major cloud computing companies. There is an over-reliance on a very concentrated group of tech sector customers. I mean, think about it. If those few massive companies decide to pull back, SK Hynix is left highly vulnerable. The high sensitivity to market corrections means that any slowdown in AI infrastructure spending can cause sharp, immediate drops in share value. The success of this offering might set a benchmark, sure, but it exposes investors to a very concentrated risk profile. Which leaves us with this final, powerful question to ponder as we wrap up this explainer. We've seen the mechanics of the ADRs, the sheer scale of these new fabrication plants, and the incredible reliance on the current tech boom. But what happens to this $28 billion bet if global AI hardware demand unexpectedly plateaus? It's a massive question that the entire financial and tech world will be watching closely in the years to come. Thank you so much for joining me to decode this incredible mega deal.